All right. So thank you guys for joining in on this webinar here. This is the Tax Tips for Business Owners presentation. Hopefully everyone can see my screen. This is a recorded webinar that we'll be doing on, just giving you tips and tricks for business owners when it comes to taxes. We'll be going through a lot, so this is jam-packed. It's fully action-packed. If you need to, if you have any questions or anything, just put in the chat box or, unmute yourself or request to be unmuted if you can be unmuted for whatever reason. But this will be recorded, so just something to keep in mind. I'll be monitoring the chat box. But yeah, definitely thank you guys for joining. Definitely thank you for taking time out of a beautiful Tuesday afternoon in order to join this webinar. We usually do this about once a month, and on a quarterly basis, we'll have some sort of in-person thing where you can network and all that good stuff. These are usually about an hour, and they're meant to be presentation, so they're really meant to, be presentation style where I present, but at the same time, you can chime in. Please feel free to ask any questions, anything that's confusing, anything you need clarification on. Please, this is not a place to be shy. This is a place to be interactive, and this is a place where, it's a safe zone. So the first thing, let me make sure everyone is muted before I start. You said, not sure I can hear you, so let me just make sure everybody knows. So I'm going to put in the chat box, but please make sure you turn on your audio when you join. You basically have to click the audio turn on. Once you activate your audio, then you'll be able to hear the presentation. But remember, this will be recorded in case there's any sort of technical difficulties for whatever reason. And remember, if you need to unmute yourself, just put in the chat box. If you're having a hard time, just please feel free to put in the chat box. But we'll go ahead and get started. So remember, we'll be talking about tax tips for business owners. So really giving you tips and tricks as a business owner, how you can take advantage of, taxes, things of that nature. So I'll give you a brief introduction of who I am as well as the firm. We'll go through some entity structures, so how you should be properly structured as a business. We'll get into taxes, and then we'll also get into how to make sure that you're prepared to file taxes. Tax prep is not the point where you begin saving for taxes or start compiling documents. That's actually the last point. That's the last thing you should be doing when it comes to your compliance. And then throughout the presentation, as well as at the end, we'll leave about 5 to 10 minutes for Q&A. We always do that, and then we usually cut it short. Like if there's no questions about after 2 minutes, then we'll just end the webinar. But let's just get right into it. So introduction of who I am. My name is Badu. I'm a licensed certified public accountant in the state of Illinois. I graduated from the University of Illinois at Urbana-Champaign, got a bachelor's and a master's degree in accountancy. I used to work at one of the big four public accounting firms and then decided to launch my own accounting firm, tax firm, 3 years ago, which is known as Badu Tax Services. I'm what's known as a parallel entrepreneur, which means somebody who runs and operates multiple businesses that are parallel to each other, or have to do with each other. And I'm also a wealth multiplier, meaning that not only do I help people find tax savings, I also assist them with investments and insurance, credit scores, things of that nature. So I overall help people when it comes to their wealth needs. I'm the founder and CEO of Badu Enterprises, LLC. That's the parent company of all the companies that I own, which the primary company is Badu Tax Services, which is a tax firm that specializes in tax preparation, planning, and representation for individuals and businesses. We have clients in all 50 states, so we're a national company, and then we're also a multinational company because we have clients in different countries, such as India, Ghana, Nigeria, and a lot of other countries. Always expanding, always growing, and we hope to continuously instill our purpose or our mission which is to help people maximize their financial security, especially when it comes to tax. Also own a company called Badu Investments, which is primarily a real estate investment company. We do buy and holds. We buy properties, we fix them up, and then we essentially rent them out to tenants at market rates. So we basically revitalize neighborhoods in order to provide housing to people. And then I'm also passionate about financial literacy. So that's another thing about me is I teach. I'm primarily a teacher by nature. I teach all across the country. I do about 100 workshops or 100 webinars similar to this. I'm live on the radio every Monday night, 7 to 8 p.m. Central Time on a station called WGAC in Chicago, 98.3 FM. You can catch me every single Monday night from 7 to 8 p.m. Central Time. And the show is called Money Talks, where basically all we talk is money. It's also a podcast. You can find it on iHeartRadio, SoundCloud, iTunes, all that good stuff. So yeah, let's just get right into the presentation. As far as when it comes to taxes, I always get the question, how should I do my taxes? How should I do this? How should I do that? Really, the first step, whenever I talk to a client, whenever I talk to anybody or I present, the first step you have to make sure when it comes to your taxes or your business, as far as once you're ready to launch, of course you should have your business plan and all that good stuff. But once you're ready to actually execute your plan, you need to make sure you're set up correctly. This is where a lot of people go wrong, and they get themselves in trouble because of it. There are different types of entities out there. You have the most common limited liability company, LLC. This is my personal favorite. As you notice in my bio, all of these companies end with the words LLC, meaning all my companies essentially are LLC. Now we'll get into the tax aspect. This is just the legal side at least. And as a disclaimer, I am not an attorney, so I'm not giving legal advice or anything like that. I'm simply giving you best practices of what I know that usually work out when it comes to a business owner as somebody who runs and operates an actual business. So LLC is a limited liability company. It is one of the entity structures. The reason why I like it so much is because it's flexible, meaning that you get to choose how you want to be taxed. You can be taxed as a sole proprietorship, a partnership, S corporation, or C corporation. So an LLC in itself is not a tax structure. If anybody says the words "I'm taxed as an LLC," then they usually either don't know what they're talking about, or they just don't have enough knowledge when it comes to this. So you're only taxed as one of four ways when you're an LLC: a sole proprietorship, a partnership, S corporation, or C corporation. So we'll get into what the differences are in the second on this last bullet point here. So it's flexible. It allows you to choose how you want to be taxed. It's also pretty cheap. It used to be very expensive in the state of Illinois, at least. It used to be about $500 to form an LLC. Now it's $150 in the state of Illinois. So it's actually pretty cost effective. In my opinion, it actually costs less than a sole proprietorship, which is an entity structure, but in my opinion, it's not a real entity structure. Nobody on this webinar, nobody in life in general, I believe, should be running a sole proprietorship that has nothing to back it, such as an LLC, a corp, anything that's like, just don't do it. It's basically what some people refer to it as a DBA. DBA is essentially what people refer to when they say sole proprietorship. And the reason why you don't want to run a sole prop is because you're not protected. The number one reason why you should set up an entity, forget about taxes now. The number one reason is because of protection, liability protection. As a sole proprietorship, you're not protected at all. Meaning, if somebody sues you, not only can they claim the money of the business, they can also go after the money, your money personally. When you have a limited liability company, assuming you're not doing what's known as piercing the corporate veil, also known as you're commingling personal business funds, you're not funding the business properly, meaning you didn't put the money in the business bank account when you started the company. or you're just doing things that make it appear that you're running a sole proprietorship. So as long as you have LLC Corp next to your name, you're protected from your personal liability is protected. It's separate from the business liability. So sole prop, I don't recommend it. It is pretty cheap and it's easy to run and all that, all that stuff, but you're not protected. So LLC, you have the flexibility to choose how you want to be taxed. And when we choose tax structure, we usually choose to be taxed as a sole proprietorship or a single member LLC. Just to keep things simple. Later on, you'll want to become taxed as an S corp or an S corporation. However, for now, I would say, as you're starting out, if you don't project to make a pretty large sum of money in the first year, then LLC tax as a sole proprietorship or a single member LLC is perfectly fine. So LLC, you get to choose how you want to be taxed. You have, you have the legal protection. So you're protected, meaning that if somebody sues you or sues the LLC, they have to sue the LLC, and if they win a lawsuit, they can only get the assets and the liabilities of the LLC, not you personally. So something to keep in mind there. And then also with the LLC, it's pretty cost effective, and it's also very low maintenance. You don't have to really necessarily keep corporate minutes or anything like that. Now you should, for me, I'm a very cautious person. So anything that protects me to the maximum, and somebody's giving me recommendations, like my attorney, for example, he gives me recommendations. Keep corporate minutes. Have some sort of certificate or have an operating agreement, for example, for an LLC. So keep these things on file. You don't have to, but it's good to do it because it keeps you protected, So LLC is one of the types of entities out there. You get to choose how you want to be taxed. You have legal protection or asset protection. You ultimately are able to, it's very cheap to run and operate, and it's also low maintenance. Those are the 4 key benefits. Now, somebody might ask, what's the downside of an LLC? In my opinion, none really. Other than the fact that you have to renew it every year, state of Illinois, between $50 to $100 or so. It's the cost of doing business ultimately. Don't think of it as a cost really. Think of it as an investment in your protection. And please be sure to renew your LLC every single year, or you will get hit with a penalty, which in the state of Illinois is about $300 if you don't renew your LLC within a certain time span. So LLC is great, love it. Now you have an S corporation. S corporation is nice too. It has the same benefit. An S corporation is basically an LLC. With an LLC, you can also issue what's known as units to investors or people. With an S corp, you can issue shares. It's the same thing, no difference. You issue shares. Now, with an S corp, the difference between an LLC and an S corp is that, for one, an S corp is a corporation. So it starts off as a C corp, and then you have to file a form in order to convert it into an S corp. So you do not have an S corp unless you convert it into, or if you convert your C corp. All corporations start off as C corps, and you have to convert it into an S corp. So with the S corp, it's just about the same fee as an LLC in the state of Illinois. There's only about a $25 difference or so. So you have the S corp. It's pretty cheap to start. Now it is pretty high maintenance. Unlike the LLC, this one you do have to keep stockholder certificate on file. So you literally have to get a certificate that shows that you're the owner of this company, how many shares you own. You do have to have bylaws, just like an operating agreement with an LLC, but you don't have to have an operating agreement for an LLC. With an S corp, you're required to, or with a corporation, same thing. And then you also have to keep board minutes or a stockholder certificate and all that good stuff. So it is pretty high maintenance, unlike the LLC. The reason why I like LLC, it's pretty low maintenance. S corp is pretty high maintenance. Although it's cheap to start and renew and all that good stuff, it's also pretty high maintenance. And if you're joining in, definitely appreciate you guys for tuning in. This is a webinar about tax tips for business owners. We just went through a brief introduction, and now we're covering the different types of entities. So the first step when you're starting a business, or when it comes to tips and tricks to properly doing business the right way, you have to make sure that you're set up correctly. So with the S corp, you ultimately have the ability to, you're protected. So legally, you're protected by law as a corporation. Your personal assets are separate from the business's assets. So just to recap the benefits of an S corp, you're protected by law. It's pretty cheap to start. And then also there are tax benefits, and we'll get to this in a second. This is a big one right here. We'll get to that in a second. But here are the downfalls of an S corp. Some of the reasons why I don't like an S corp, it's high maintenance, for one. Two, you can only have up to 100 owners. So if you're trying to go big, then an S corp might not be the best route. Eventually, you might have to convert back to a C corp where you can have an unlimited amount of owners. You cannot have foreign shareholders, so nobody from Canada or any other foreign country can own your company. And then it can usually only be owned by individuals, so no creative structures, with all these weird LLCs owning this and that. So it is pretty restricted. It's really meant, S stands for small. So S stands for small, or small business. It's meant to be like that. They created specific laws for that. And we'll get to the true tax benefit in a second. But with an S corp, you do not have to pay what's known as FICA, or self-employment taxes. Very, very big. Outside of your W-2 or your salary, you do not have to pay self-employment taxes as an S corp, which is very big. Now let's go to the last one, C corp. C corp is the same thing as an S corp. The only difference is with a C corp, you can have an unlimited amount of owners, you can have foreign shareholders, all that good stuff. C corp is usually for a large company, such as Apple, Microsoft. Companies are looking to go really, really big. Now remember, with an LLC, there's no limit on how many owners you can have. So a C corp is infinite amount of owners. Here's the downside though. With a C corp, it has double taxation, meaning that not only do you get taxed, so an LLC, S corp, C corp, you're getting taxed on the profits. If you made $100,000 net, so income, let's say you gross $200,000 for your business expenses, meals, travel, all that good stuff. Business expenses are $100,000. You're left with $100,000 net. You're still going to be taxed on $100,000 no matter what. Let's apply the tax rate of about 22%. Tax rates, of course, did go down with the tax reform that started in effect in 2018. So essentially, you're always taxed on your profits at all these levels, no matter what. However, with a C corporation, if you distribute money outside of your salary, you have to pay double taxes. So not only do you have to pay taxes on a profit once, but once you pay it to yourself, you have to pay taxes again. And this is what they call double taxation. Basically, it's a dividend. It's a dividend to yourself where you have to pay taxes on it. So with a C corp incurs double taxes, meaning taxes at the corporate level and then also taxes at the personal level as well, at the long-term capital gains rates or the dividend rate between 0 and 15%. I'm sorry, 0 and 20%. So just something to keep in mind there is, as a C corp, it's not a good idea if you're a small business to be running a C corp. There's no reason why you should be. If anything, convert it to an S corp or do an LLC and tax it as an S corp or a single member or even a partnership. And I didn't mention partnership because all partnerships some are sole props, or some are started like a sole prop where there's no protection. And usually most partnerships are LLCs that just have 2 or more people. So that one you can only elect to be taxed as a partnership or an S corporation or a C corporation. So why should you incorporate? I mean, we covered these. you should incorporate because it enhances your credibility. So if somebody sees the words LLC, INC, CORP, all these fancy, titles, or abbreviations or acronyms, they're going to be much more impressed with your company. So just something to keep in mind there. It enhances your credibility. It makes people take you a little more serious when it comes to running a business. They expect to be working with a business, not working with somebody who's just running a mom and pop shop that has just a soap prop. So everybody who's looking to get into business, I think, unless you have a pre-existing business that's, for example, if you're an Uber driver or, you're an independent contractor of another company, now that's different. You can incorporate, and you might want to consider becoming an S Corp, but you don't necessarily have to if you already have an existing company that's behind it. So the main reason why we incorporate is to protect ourselves, which is the second point. It's to protect your personal assets. Meaning if somebody sues you, if you have an LLC, INC, CRP, they cannot touch your personal assets. They can only touch the assets of the business. And then you also get easier access to capital. There are certain banks that will not work with, individuals that are running sole props or no entity structure. So that's the reason why you should incorporate yourself. That's the first thing you should be thinking about when it comes to taxes, when it comes to your business, not necessarily the tax stuff. Tax stuff, it's good to keep it in mind, but this is what you have to do first. And then what are the benefits of an S Corp? You do not have to pay self-employment taxes or FICA. Self-employment taxes are about 15.6% or so, give or take, which is pretty big. 15% on $100,000 net profit is $15,000 in FICA. As a matter of fact, when we do tax planning, which is one of our core services, it's actually our number one service in the firm right now. The first thing we bring up when we see a business owner who is making over $40,000 is we say, well, why not, move to the S Corp format? Now remember, an LLC can be choose to be taxed as an S Corp. So you don't have to set up an S Corp. You can elect your LLC, your existing business LLC, to be taxed as an S Corp, or you can just start, a fresh new S Corp. So the reason why we start an S Corp, really the only reason outside of the legal stuff, tax-wise, is because of the self-employment tax, the FICA, the Social Security tax. There's so many ways that they call it. You save about 15% or so gross. Now, there's other things you have to factor in. That's where we get into more tax planning. But at the same time, the reason why we start an S Corp is to save you that 15%. Now, you do have to do things like run payroll as an S Corp. Usually we run payroll at only 25%. So payroll meaning W-2, just paper payroll. We're not talking about how much you're truly paying yourself. You can pay yourself 100%. But how much you have to channel through payroll, according to IRS rules, as an entity tax as an S Corp, is you have to pay reasonable compensation to the owner or owners. And usually we run that at about 25% of net business income. Remember, you always look at net profit, not gross income. So after expenses. So 25% through payroll or W-2. And then the other 75%, hey, you can leave it in the company. You can pay it to yourself. You're still going to pay taxes on 100%, regular income taxes on 100% of your profit. However, 25% has to be, at least 25% has to be allocated towards payroll. That's where you incur the FICA, the additional 15% or so. But you save 15% on 75% of your net profit. I know that can be confusing, so if you need clarification on that, please let me know. We will have time at the end to do a quick Q&A. And if you're tuning in just now or recently tuned in, please ensure that your mic or your speaker has been turned on. You have to turn on your audio. This is also posted in the chat box. Make sure your mic is turned on. Everyone is muted for now, but if you have any questions or anything, just type it in the chat box or just say, just raise your hand, do something to signal that you want to talk. We do have a few team members on here that can chime in on some stuff, but let's just get right back into it. So taxes. Now that you have your entity structured, you have your LLC ready, you formed it, or you utilize our services, we also help people form entities too. We do provide that as a service through Badu Entity Formation. Um, so we can help you set up your, your LLC, your S corp, any type of entity. We do not set up nonprofits, however. So when it comes to taxes, why should you file taxes? Why in the world should you even file? Like, what's this tax thing? I seen a video online that you don't have to file taxes, and I can assure you, you do, or you will go to jail. There are some famous people that have gone to jail, and the only reason why they were able, or that they were found guilty of anything, was because of tax evasion. Tax evasion is illegal. Tax avoidance is not illegal. Trying to minimize your taxes is absolutely legal. Tax evasion, where you're not trying to file or pay taxes when you're legally responsible for it, is illegal and can land you in jail for a pretty long time. So why you should file your taxes? Because you earn an income. If you earn money as a self-employed individual, if you earn over $400, you have to file a tax return. So if you're 1099 or you start a business, if you netted $400 during a year, you have to file an income tax return because of the FICA. The government needs their FICA taxes to be collected. And then if you're a W-2 employee, you're single, and you make over $12,000, you have to file. If you're married and you make over $24,000, you have to file. And those numbers are the standard deduction amounts. And you should always file, no matter what. Even if you think you shouldn't file, at least consult the expertise of a tax professional and go ahead and file. I have some clients that come in here and say, oh yeah, I didn't know I was supposed to file, and they're 5 years late. There are very steep penalties for not filing, including jail time, by the way. It doesn't usually get that serious unless it's like big time tax evasion, but not filing could land you a tax evasion case for sure. Which goes to the second point. It helps you stay compliant with tax laws and regulations. It is a crime to not file taxes. It's a criminal offense to not file your taxes. So you should file annually, and you should potentially pay quarterly estimated taxes. So you don't file quarterly potentially, but you're filing or you're paying quarterly estimated tax payments because the government needs their money now. They need it, throughout the year, not at the end of the year or next year. They would like that if you're making a profit, assuming you're not a W-2 employee, that you're making your tax payments consistently. Best rule of thumb is you look at your P&L, your profit and loss each quarter, using something like QuickBooks, hopefully, and your P&L or profit and loss is up to date each quarter. You go in there, you look at your profit for that quarter, make sure it's up to date, and you take that number and you multiply it by 20%. You take that 20% and you send it to the IRS. And then you take 5%, you send it to the state of Illinois. So overall, you're at 25%. And if anything, if you've overpaid at the end of the year or next year when you file your taxes, you'll get a refund. That's what a refund is. It's a refund of money you've already paid. Some people think a refund is money that the IRS is given to you for free, or that's not what a refund is. A refund is money that you've already paid to the government. Or if you're short, let's say that maybe you had a big bonus at the end of the quarter or at the end of the year, then you just owe some tax. Now, you more than likely will not incur a penalty because you probably, you probably were within the limits when it comes to making your estimated tax payments. So they don't expect you to be 100% accurate. They know that your number will actually never be spot on. So that's why we call it an estimate. It's estimated tax payments. You do it every quarter. And also, if you're an S corp, we usually run payroll quarterly. We run it at 25% of your business income. So while you should file, you can get a refund. You can definitely get a refund of money you've already paid, unless you are in these three categories. You have the Earned Income Tax Credit, the ITC, the Child Tax Credit, CTC, or the American Opportunity Tax Credit, AOTC. Those are the only three categories of people that the government is actually sending you extra money, basically. So we call those tax credits, refundable tax credits. So you can get a refund by filing your taxes at the end of the year or when you file your taxes the following year. And as a business owner, we'll get into this now. You can write off most of your expenses. And here we go. And you should write off your expenses. To write off expenses doesn't mean you're doing anything illegal. You know, time and time again, I get clients that think that certain things are illegal. I'm like, well, read the tax code. There's over 18,000 pages of the tax code, and more than half of it was created for you as a business owner to save taxes, not to pay taxes. Tax code was created to minimize taxes, not to pay taxes. You know, that's one thing that you have to, the code is to your advantage, and you should use it as such. You know, so in order for a tax write-off to be legitimate, or in order for you to write off, remember, write-off is simply, let's say if you made $100,000 gross income during the year, and you spent, or you incurred business expenses of $50,000, then a write-off is simply you're reducing that $100,000 gross by $50,000 to be netted at $50,000. So that you're going to be taxed on $50,000. A write-off is not a refund. The IRS is going to send to you. A write-off is simply a reduction of your taxable income. So when we say write things off, we mean reduce your taxable income by your business expenses. And you should write off whatever you can when it comes to business expenses. So as a business owner or a self-employed individual, you're allowed to write off certain expenses to reduce your tax liability or your taxable income. In order for a business expense to be legitimate, it has to be both ordinary and necessary. Ordinary simply means that it's ordinary in the nature of your business. Hey, it's ordinary for a tax firm to have a tax software. It's ordinary for a rental company or a real estate company to actually have the real estate. You know, it's ordinary for a real estate agent to be paying commissions to their broker, unless they are the managing broker. And then necessary means that it's necessary for you to really thrive in your business. It's very necessary as a CPA to be taking my clients out to dinner or lunch. It's very necessary for me to go on trips to Jamaica, you know, where I can meet potential business partners or potential clients. Very, very necessary. So anything that can be deemed as ordinary and necessary, and remember, necessary meaning necessary to grow your business, then it's perfectly fine. Examples include meals, travel, fees, commissions, dues, subscriptions, things of that nature. So always keep these things in mind. It's not illegal to write off a meal that you're having with somebody you're discussing business. It's completely legal. What makes it legitimate is the fact that you're discussing business either before, during, or after the meal. And how you do this is you make sure that when you get handed the receipt, you know, just make a quick note, ate with so-and-so, and just write down one word of the topic you talked about. You know, it's already going to be time-stamped. It's already going to have the amount, the card that was used to pay for it, the tip and all that. And what I do is I just take a picture of it and just store it in a folder somewhere. And you can either attach it to your QuickBooks account, all that good stuff. So meals, in order for a meal to be legitimate, it has to be ordinary or it has to be about business, basically. And this includes meals that you have during your travel. Now, any meal you have by yourself is not tax deductible unless it's travel related. So if you're on a flight and you ate a meal, that goes under the travel category essentially. So travel, this is big right here. Anytime you're driving, if you're a real estate agent and you're driving to showings and all that, track your miles. QuickBooks has an excellent mileage tracker feature. You know, you can track your miles. And then if you have a car, so when it comes to the auto expense deduction, you can either take the mileage method, where you're just writing off your miles. You're taking your mileage amount and multiplying by the standard mileage rate, which is about 58.5 cents per mile or so. Or you can do the actual method, meaning you take depreciation. So if you have a vehicle, you can depreciate up to $18,000 of the vehicle in the first year, even if it's a used car. You also have to factor in gas, maintenance, registration, insurance, everything, all, you know, interest on your car loan, everything you can think of. So at the end of the year, you can compare the two figures. You added all those numbers up and you compare it to your mileage and see which one gives you the greater tax benefit. QuickBooks will tell you this. And then travel, also overseas travel or out of town travel. So anytime you're going to a conference, you're going out to Jamaica, you know, another reason why you want to have like an LLC, S Corp, or C Corp, it makes your expenses look much more legitimate. You know, it makes, basically, it's like, okay, you're a business, so you should be expected to be doing things business related. You should be taking minutes, you know, having board meetings, whether you're the only board member or not, or maybe your spouse is a board member. So for example, my team and I, and by my team I mean my spouse and myself, we're going to Jamaica at the end of the year, and we're calling that our annual board meeting. Perfectly legal. All we have to do is declare it. You know, we own a company together. We own a life insurance business together. So for the life insurance company, that's going to be our board meeting for the year, where we're going to Jamaica for 2 weeks. And we're talking, you know, at times, of course, there will be times where we discuss business. But as long as it's declared as a board meeting, and then we actually have a day that we designate, we say, okay, on Monday from, you know, 10 a.m. to 10:30 a.m., this is our board meeting. This is what we talked about. You know, these were the people that were present. This is how the quarter looked. As long as you're doing that, it's perfectly fine to travel. You travel for 2 weeks, a week. Apple does the same thing. You know, why shouldn't you? So you can have up to about 4 board meetings a year. If you don't want to call it a board meeting, you have to work at least 4 hours a day, so half the day basically, except for travel days and the weekends. You get those off. You don't have to work during those days. You can still count 100% of the travel. So whether you're going to Jamaica, whether you're going to, you know, anywhere you're going. So Alice asks, we have a question here. Is meals, travel fees, dues 100% deductible at this point? Meals is 100%, I'm sorry, 50% tax deductible. Travel meals are essentially 100%. So travel is 100, it could be 100%, fees are 100%, dues are 100%, but meals are 50% tax deductible. Normal meals that you're having, you know, in town, basically. So fees, dues, these are all examples of deduction. And then retirement savings. As a business owner, you can write off, you can contribute up to about $56,000 a year towards retirement. You know, and you can do more than that, but these are just through the traditional retirement accounts, specifically business owner retirement accounts. Business owners can save way more for retirement than a normal W-2 employee. A W-2 employee can only save about $19,000 a year. You can save $56,000, and that's not including your spouse. Your spouse can save another $56,000. Your kid can save another $56,000. Always be sure to hire your kids. You know, if they're of legal age or if they're of age to work, then why hire Betty the, you know, the bookkeeper, or, you know, Sally the cleaner, when you can just have the kids do it and just pay them a salary? And guess what? If you're paying them up to $12,000, you get to deduct that on your taxes, and they don't have to pay any taxes on it, because that's their standard deduction. You know, so just something to keep that in mind. When it comes to a business, you can truly write off a lot. So moving along, we got about 10 minutes or so. I mean, we'll leave the last 5 minutes for Q&A, so we got 5 more minutes of presentation, and then we'll open up to Q&A. As a business owner, you can write off your home office. Home office, you can either use the simplified or the regular method. Simplified method simply meaning that you take $5 and multiply it by the square footage of your home office, and that's it. So if you have an office space that's 100 square feet times $5, that's $500. Simplified, very simple, easy. Or you can take the regular method. Regular method is when you add up things like your rent, utilities, all the housing expenses, stuff that's not 100% business related. If it's 100% business related, you can just write it off directly. But if it's not, then you just pull it all together, and then you multiply it by the square footage percentage of your home office. So it's home office square feet divided by total apartment or house square feet, and whatever that percentage is, multiplied by your individual expenses. Now, if you own a home, you should use a simplified method, because then you can basically double dip in a way. If you rent, then use the regular method, because as a renter, you can't deduct any of your home expenses if you're not a business owner. As a homeowner, you can write off mortgage interest, property taxes, PMI, or private mortgage insurance, things of that nature. So you have to really talk to a tax professional on what to decide between the two. Health insurance premiums, any premiums you pay towards your health insurance is tax deductible as a business owner. And also 1/2 of self-employment or FICA tax. So remember that 15% I talked about? You can actually deduct half of it. It doesn't mean that you actually paid only half. It just means that you can deduct half of it. So effectively, your FICA is really about, give or take, 10 to 11% instead of the 15 or 16%. That's why I said that 15% is not the true tax savings of an S corp. And then consider registering as an S corp for tax purposes. Very, very important. Now our last slide is QuickBooks. It's very good to have QuickBooks. It helps you keep track of your expenses. It allows you to automatically download and categorize transactions, participate in online billing, create professional looking invoices and estimates, upload receipts through your phone or through, a device, and then create customized financial reports as well as tracking inventory. It's a full-blown accounting software, meaning that it's really the best of the best that's out there. It has a professional look and feel. It is the #1 software in the industry when it comes to small businesses. It has plenty of discounts offered, especially if you're working with somebody like a pro advisor, such as myself. And then it saves business owners a ton of time, tons of time, about 10 hours or so a month on average. They said, So QuickBooks is great. You basically just link your bank account and then start syncing everything in there. You just click. You'll get QuickBooks to a point. Like right now, I only spend about max 30 minutes in my QuickBooks every week. And that's across 11 companies. So imagine if you have one company, you probably take 10 minutes. Once you've really, really mastered QuickBooks, you click, and you're done. It's not really meant to be complicated. Now, the con is that you do need some type of training if you want to learn all the great features that it has. But QuickBooks is great. Highly recommend it. Starts off at about $5 a month. Very, very cheap. Low cost, for a business. So definitely something to keep in mind there. QuickBooks is great. Excel is also fine, FreshBooks, all these other sites. But if you really want to take your business to the next level, I think you should have QuickBooks. Now let's have a quick Q&A. This is my contact info here. You can email me at jb@badutaxservices.com or 773-679-7198. Find us on social media, all that good stuff. But let's get into the Q&A, and I'm just going to unmute everyone. All right. And we do have a few questions that popped up, so I'll take those first really quick. It's William asks, can we have a more advanced training for businesses over 250K? Absolutely, we certainly can. And that's going to be more so focused on the S corps and how to strategize. I mean, we can get as advanced as we need to be. I mean, to the point where our brains can be ripped out. But we can definitely, as part of one of the next trainings, we can do one that's for businesses that, have advanced. Then Crystal said, I have a question. For business owners that are also W-2 employees, can you contribute the maximum to your 401k at work and your business retirement account? So yeah, this one is a little weird, but unfortunately not. So basically they combine them all. So if you have 19,000, now if you have a 401k plan at work, for example, and then you also have a retirement plan, a 401k. So the nice thing is these plans, like 401k and IRA, are two completely separate legal things, or legal retirement plans. So a 401k's contribution limit is not necessarily tied to an IRA's contribution limit. So for 401ks, it's safe to say, okay, the maximum you can do is 19,000, right? So if you're a W-2 employee plus your regular business owner contributions towards retirement. Now you can do an employer match. You can match up to 25%. You can do a profit sharing plan up to 25% of your net business income. So if you made 100,000, you can add an additional 25,000 in the year, and that can be counted. That can go into the solo 401k plan. So the employer match has no limits really, except for that 25% limit. So as far as employee contributions for 401ks, yeah, that applies to all plans, whether it's W-2, whether it's, so your employee contributions are together or all combined, but your employer contributions are separate. And also keep in mind that, that does not include Roth IRA or traditional IRA. That's a separate limit. And also that doesn't include things like HSA, annuities, life insurance. There's so many ways. I mean, you can dump all your money into retirement if you really want it. It's a great question there, Chris. So hopefully I answered your question. Anybody else? We got about 4 more minutes or so of Q&A. Any burning questions? Anybody?
Hey, Jeff.
Hey, how's it going? Who is this?
It's going well. This is Josh. I did have a few questions. I just wanted to know if I heard this correctly. So reasonable compensation is 25% of net income, and that's where you pay the additional pocket tax?
Correct. That is correct. Assuming you're an S corp.
Mm-hmm. Right. Taxes in S corp. And then the other 75%, you said you can keep in the business or be given as distributions?
Exactly. That's where you don't pay that 15%. That is correct. But you do pay your regular tax rate on it, though.
So the regular tax rate for an LLC, being taxes in S corp is what?
It's between 10 to 35%. I'm sorry, 10 to 37%. Between 10 to 37%.
Okay. And there was another question. Okay, right. So would in that aspect, being self-employed, is that a special way that you pay yourself as a member? Like whether writing yourself a check as just a distribution or like through employee payroll? So I heard there were 2 different ways to go about that.
You mean like no S corp involved whatsoever?
Yeah. Well, no, as an S corp.
Yeah. So with an S corp, that 75%, you can quick pay yourself. You can wire it. You can do whatever you want. There's no formal way to pay yourself outside like. The 25% though has to be ran through payroll, meaning a W-2 or like something like that.
Okay.
Mm-hmm. Does that make sense?
Then, yes, it does. And so one more question, kind of to the beginning. If you're a new small business or a new LLC, when is it best to become a S corp versus just a single member LLC? Like, if you're not really expecting to make a whole lot of profit in the first year or two, should you stay as a single member LLC, or what are you better to do an S corp?
Yeah. So the rule of thumb is once you hit $40,000 in net business income or net profit.
Mm-hmm.
Yeah, because it costs money to run an S corp. You have to file a separate business tax return. You have to run payroll. There's a tax called the replacement tax for Illinois, for example, which is about 2%. So there's a lot of different things that factor in. But once you hit 40, it makes sense to just go ahead and become an S corp.
Okay, and then does that would affect your status of your business? Because I remember filing to be an S corp a while ago. I know it was going to be a while.
Got it.
If that's the case, I think I would like to go back to the single member LLC until we expect to make larger profits.
Yeah. So only way in reality is to call the IRS, unfortunately.
Okay.
If you contact the IRS, give them your company's name, give them the tax ID number, they'll tell you exactly what they have on file. And if it's not an S corp, you just go ahead and send in the S corp paperwork. Which, by the way, the S corp paperwork can be submitted even the following year, and it still counts towards the previous year. It's a trick. I don't recommend it, but if let's say you forgot somehow or you didn't know that they did not accept it, maybe they rejected it and you never got the letter, there is a way you can still be taxed as an S corp. Now that's where you really have to work with a tax professional.
Okay.
Mm-hmm. Yep.
Thank you.
Does that answer your questions?
Yes, it does.
Got it. Okay. Yeah. So and for those who need to log off, please feel free to do so. I'll stay for about 2 minutes and take more questions. And for those logging off early, definitely appreciate you for joining. Hopefully you learned something. You know, if you need additional information, please feel free to reach out. If you need access to the PowerPoint, this will be recorded, so this will be posted live, and the link will be, distributed and all that good stuff. So definitely thank you guys for tuning in. I'll be staying on for about 2 minutes to answer any questions. You can put in a chat box. You can speak. And we do this about once a month or so, and then we also do a quarterly in-person type of training. And if you want me to do this to a group of people that you think would benefit, be more than happy to do so. And of course, if you need any services, please feel free to reach out. Be more than happy to help for sure.
Hey, Jeff.
Hey, what's up, man?
Hey, this is Ellis. I have a question here. So just going back to kind of the beginning of your presentation, I went ahead and formed the LLC. Should I go ahead and when I do make the 40,000, should I convert it all the way to an S corp, or should I just elect the S corp status?
Yeah, it would be best to just elect the S corp status, because to just form, basically you would be wasting money if you were to start a brand new S corp. Just knock out 2 birds with 1 stone, elect it to become an S corp, and your life would be pretty easy after that.
Okay, cool. And I know you kind of mentioned that you have to form when you form the S corp, you can't go straight from an LLC to S corp. You have to form a C corp, right? Is that correct?
Yeah, if you want to become a brand new so a C corp, it's kind of weird. It is true what you just said. But if you think about it, you are an S corp if you're an LLC taxed as an S corp. In reality, you're still getting the same benefits. You're still getting the FICA tax savings and all that. But in order to become an S corporation, you do have to first start a C corporation and then elect it to be taxed as an S corporation. So you are right, but in reality, if you're an LLC taxed as an S corp, you're getting the same benefits.
Gotcha. So if I get the same benefits, would I have to comply with the whole payroll thing as a S corp?
Once you become taxed as an S corp, you have to comply with the tax rules of an S corp. Correct.
Okay. All right. Cool.
Yes, sir. The only difference really is that you're not, you don't have to have bylaws and all this other stuff. You don't have to be restricted to what S corps are restricted to as far as owners and all that. You're using a loophole in order to be taxed as an S corp and get the benefits while not being an actual S corp.
Okay. Now, sorry, it's now longevity. Will that work out for me if I just keep the LLC and be taxed as an S corp and just keep that?
Yeah.
The long haul. It's no reason for me to fully convert to
right.
S corp. Right.
Yeah.
Okay.
There's never a reason to. I mean, I don't see why you wouldn't be. It's perfectly fine for sure.
Okay. Thank you.
Exactly. All right. Definitely appreciate you guys. Any further questions, please go ahead and reach out directly. We'll be stopping the recording at 1:04 p.m.